Now, the great thing about learning from somebody who actually does this for a living is that they'll tell you not just what everything means, but actually what you should and shouldn't use in the real world. You see, a teacher or a book will tell you how other people use certain indicators. A practitioner will even tell you what they don't use, even though other people use it. And one of those things is the moving average. I'm going to explain the moving averages in a second, and then I'm going to explain to you why professional traders such as myself don't use it. So why am I teaching you it? Well, it's very popular, it's very prevalent, and by showing you what it is and why I don't think it works as well as the systems I am going to show you, it allows you to avoid asking the question, well, Alpesh, what about moving averages? What about those? So let me explain what is a moving average. First of all, now you see on screen, what happens to be there is a bar chart. It's the Euro US dollar that you can see on the screen. And what I've drawn is the simple moving average over a 50 period, and the simple moving average of 200 period, and simple moving average of a 20 period. What the heck does that mean? Well, a moving average is simply an average of the price over the past number of periods. In the case of the 20-day simple moving average, it is the average of the last 20 days that the price has done. Why is it moving? Well, obviously the last 20 days, each day, change, because as each new day comes in, the average changes because you're only looking at the last 20 days. So it's called a 20-day moving, because obviously it's moving each day. Average, well, we all know what an average is. Why is it simple? What's the difference between simple and exponential, which is the other type? Simple just adds all the prices that the price closed the last 20 days and divides by 20. That's simple. The exponential weights them. Through mathematics, it gives more weight to the most recent price and a little bit less weight to the day before, yesterday, and so on until you get the 20th day, which is given hardly any weight. Why? Well, the idea is that what happened today, yesterday, the day before is far more important and should be weighted than what happened 20 days ago. And that's fine. In my experience, it makes very little difference. So how do people decide when to buy and sell based on this indicator? Well, some will simply use the 200-day moving average as a resistance or a support line. They'll say, well, the price will hit that and go off. If it's rising, they'll say it's an upward trend. If they see that the price is above the 200-day moving average, they'll say it's bullish and they'll stay long. All of that seems fine. You know why I don't like any of those strategies? And by the way, some people will say if the shorter period moving average, i.e. the 20-day or the 50-day, goes above the 200-day, for instance, at this point, then you should be bullish. And they work that out, and it might sound like mumbo jumbo, they work that out on the basis that if short term it's moving up but the long term is still intact, then we should go long, and so on. So there's lots of rules they can come up with, and that's fine. It works very well when the market's trending smoothly upwards. And you would see in a chart like this, if you'd adopted that rule, you'd be fine buying long if it's either above the 200-day moving average or the 50-day is above the 200. Any of those rules, you would have been fine on this. The problem occurs not when the market's moving upwards like this. The problem occurs when it's going sideways. Now here we didn't have a problem in this sideways move, but actually we did. For a number of periods, it was going downwards and making losses. We could easily have made more money by exiting, going short, maybe going long again, and so on. So the problem with the moving averages, when the markets move sideways, it's not so accurate, gets you in and out of the market very quickly, or you miss a lot of opportunities you could otherwise have had by not just hanging in there and waiting. It's a simple way of saying it's what we call a lagging indicator, somewhat delayed. When it works great. When it doesn't work, unfortunately, you lose all the money you made from when it worked great. That's why I don't like it. It's also why other people do like it, because they seem to persist with it and say, nope, I'm going to keep going because there's enough winning trades. Let me just show you that example again of how other people use it. They either buy when the 50-day simple moving average crosses over the 200-day, or they establish the 200-day moving average as the uptrend, and you can see it working fine when it works. It works fine. But I just don't like it because it often gives me too many delays. But I wanted to show you it. Or with the 3 simple moving averages, some people will just add more and more on the basis. They'll say, well, okay, can we improve by, instead of just having 2, let's add a 3rd one, as if life wasn't complicated enough. And they'll say they use the longer term one, i.e. the 50-day, as confirmation. So they won't do anything until the price is beneath or above all 3, or all 3 crossover. So as you can see, it can get very complicated. I don't need that level of complication. I think it's too delayed. I think when you're wrong on it, when it's wrong and it doesn't help you when the markets are going sideways, which is when you need it the most, it's too lagging and it's not accurate enough. But I wanted to show you it because it's so incredibly popular. But I'm going to focus on the systems I've used in my own